Good afternoon, you filthy apes. Welcome to AMC and ADD, where we buy, we hold, and we screw the hedgies. Screw the hedgies! Hope you guys are having a great weekend. I promised everybody a little bit of a presentation this weekend, so I'm going to give it to you. Here's what we're going to talk about. How to recognize synthetic price failures versus paper hands. This is going to be a two-part series. Part one is about talking about SPFs. You're not going to hear this anywhere else. SPFs are specific to something that I've created after having modeled out the GME squeeze and noticing that there's very specific patterns in algorithmic trading. What is an SPF? It's a synthetic price failure. It's essentially what hedge funds use to try to drop the price by a certain percentage in order to try and create or elicit the most amount of paper hands that they can to get you down in price to just create fear, uncertainty, and doubt and just generate paper hands. So let's talk about that. What is a synthetic price failure? 20% drop in price from the most recent high. So you're thinking to yourself like, okay, well, what does that look like? Well, let's talk about two other points real quick first. I want you to identify that there's a difference in some of the turning around points that they typically have. Anything down to a 20% drop in price from the most recent current high, not current total high, but just a more recent high that was previously made. That is a synthetic price failure. That's where it begins. That's the point at where it begins, and it typically can turn into a turning around point in price in the future. Another one of those turning around points would be a 35% drop in price from the most recent high price, or a 60% drop in price from the most recent high price. If it's gone beyond 23%, if it's a 23% or greater, then there's more than likely somebody selling. It doesn't necessarily mean retail, it could be institutions, but somebody is more than likely selling because a real synthetic price failure typically only is a 20% drop in price. So let's examine the true tracking of an SPF. So what you have here, this is, I believe, AMC from 723 down to 811. This is the price movement, and it's looking at it from I think probably a 15 or 30 minute. It's probably a 30-minute time interval. Uh, you'll see here the way that I track it is I track my price history on an Excel spreadsheet. I've got my price history column. I've got a price change column, which is just a calculation that shows me how much it's changed from one point to the next. And then I record the dates in which that point started and when it ended. So in other words, when you see 723 on there for that very first number of $40.94, the run started on 723 and it completed that $40.94 completed on 727. And then what I just simply do is I count the amount of days that it took to change. And that's a fourth column. And I only like to track the days to change just because I like to kind of see like a pattern. I like to look for patterns. There's nothing really specific about that at all. And some people will notice that I'm counting weekends in there. It's a flawed method. Um, it's just something I track. I wouldn't really put too much. You don't need to have a days to change. You just don't really need to have that column. It's not really needed. But $40.94 down to 28.57 is a 30.2% drop in price. Now it started to make a turnaround at that point, and that's not specifically on that 20% or that 35%, but it is a turning around point at 30% there. So perhaps they found the most amount of paper hands that they could find in that rundown, and then there was no more. There was either enough buying pressure for that to need to turn around and start running back up. They couldn't afford to continue to drop the price, too much buying pressure, or sometimes they do stop loss hunting for stop loss limits or limit orders that are out there. And if they're not finding any more, then they'll just start letting the price run. Well, they start letting the price run. They run it from 28.57 all the way up to $38.23. That took from 8.5 until 8.10. Now, in between, there was a point where the price started to drop back down. What I want you to remember is that in these synthetic price failures, you're tracking new highs and new lows, but you're not tracking all of the lows. The lows have to be greater than 15% at a very minimum. a very minimum. And when I say 15%, I'm talking like the price really needs to drive through the 15%, not just touch 15%. If it touches 15% and starts coming back down, or maybe even it's just slightly higher than 15%, it starts coming back down, then you're probably not done seeing either new lows. Well, then you're probably just not done seeing new lows. There's going to be another new low that's coming in. Or it might touch 15%, come back down a little bit. Maybe they don't find any paper hands that are still out there, and then they let it continue to run more, which is more typical to what you're seeing right here on the screen right now, where they ran the price upwards, brought it down just a tad bit, and they're like, okay, yeah, there's nothing else here to get, so we're going to continue to let it run. So then you track a new high. You're on new highs because it's gone past a 15% correction towards the positive. It ended up being a total of 33.8%. Now, I do want to preface this real quick. You'll notice in the notes it says over to the side, typically a price moving 15% or over the last low is a good indication that the next high is coming. However, keep in mind that when you get larger dips, up to 35% or plus, those dips, typically speaking, you can see some 15%, 16, 17, 18% increases in price, and I would not reset your synthetic price failure at that point. I would wait for 20. 20, when you get into those larger dips, wait for those 20% points to hit, and then reset your synthetic price failure. So resetting your synthetic price failure is always, every time you pass that like 15% mark, you're going, okay, I'm going to reset. I know there's another synthetic price failure possibility that's going to come. I just don't know when. And so you're looking for it, you're waiting for it to happen. If the price moves down further at the yellow arrow, and that's the last note here, if the price moves down further at the yellow arrow, the new low will replace the 28.57. That's all I'm specifically just trying to point out there is that if on this trend right here it had started to run back down more, it would have been a newer low. So here's another run here, and this is just simply, I'm just looking at these four specific um, price points here because I just want you to see what a synthetic price failure looks like. So from the 38.23 down to which started on 8:10, ran to the next day because this was in the pre-market hours. So it ran over to the next day, and we found a new low. It was a 23.1% drop in price. And we're just tracking new lows. You just keep entering in the new price. What I do is on my Excel spreadsheet is I just, every time the price gets lower and lower and lower, I just keep tracking it. And when it breaks that 15, or that, sorry, the 20% synthetic price failure point, then I start tracking those numbers and I go, okay, we're finding new lows. Those were, let's see how far down that's going to go. Just simply just tracking new highs and new lows. It's as easy as that for synthetic price failures. There are things that will catch you though. So I've just shown you what an easy synthetic price failure looks like, a tracking of it over 4 periods of time where it was up twice and down twice. I'm going to show you some areas where you can kind of get tricked a little bit on synthetic price failure tracking. So is this SPF real or is it a sell-off? So what you're looking at here is GME. This is on a different time scale. I believe the time interval on this is looks like it's probably 5. No, let's see. This is probably, yeah, it looks like it might be 5-minute intervals. So what you have here starting off for price is it right here at this first green circle down to the first yellow arrow is a 36.6% drop in price. That's 136. The price value is 136 here. You're gonna have to take my word for it on this because I can't get all the prices to show up. I can only get highs and lows to show up on the screen. But it was 136 for a high here, and it dropped down to 86.25. And then price started to run back up a little bit. From the first yellow arrow to the second yellow arrow is an increase of 17.9%. Now, the one thing I want to show to you here is that 136 down to what was the first price I said? 86.25. That's not a synthetic price failure. I mean, it is a synthetic price failure, but what you have to realize is that there's new lows that are tracking because it never actually tracks higher than a, what did I say, 17.9% increase in price. So this is one of those tricks where I said you got to be looking for 20% upwards rip. Otherwise, you're tracking new lows. So it never quite makes, because this is such a large drop in price. It was a 36.6. It's over that 35% marker. You're looking for 20%, not 15%, because you've moved into bigger size dips. So this is, while this is technically a synthetic price failure, it's not the bottom because it never had a correction to the top. So you're still tracking new lows. You could be watching for new highs. If it had broken past 20% here, I'd have been like, yeah, you broke past 20%. This is definitely a new high. I didn't track this number right here, but I'm pretty sure this is going to be underneath 20% as well. But then you end up having a new low, 65.01. This is your bottom. So you have to be really careful about tracking here. If you did write this down as a synthetic price failure, then you would have recorded this as a 36% drop in price. You would have recorded this as a new high, this as a new high, and then you would have recorded a new low, and you would have been tracking this as a lower dip. It would have been a much smaller dip than your previous one. And that's kind of dangerous when you're recording synthetic price failures, which will be part two. Knowing why tracking these synthetic price failures so accurately is important, because if you stumble and you track this as a synthetic price failure right here, then you're going to be seeing dip size over dip size decreasing, and then you don't want to do that, not unless it's real. So the actual dip size here was actually a 52.2% drop in price. That's what it ended up being from this green point down to 65.01, 136 down to 65.01. It was a total of 52.2. So this dip wasn't a 36.6% dip, it was a 52.2% dip. Then you have your run up to 159.18, which ended up being a 144.9% increase. You can see the dates here. I've got the dates listed. This was actually the very first time, for those of you who are kind of curious, this would have been the first time where apes would have woken up. If you want to imagine this being AMC, you would have woken up somewhere around here in the morning. You would have seen the price had gone all the way up to 136 back down to 65, and you would have been like, "Oh my gosh, I missed that. I can't believe I missed that. Is it over?" And then the market, it drops just before market open, and then market open it runs all the way back up to that $160 range. Guess what it does after this? It drops way back down again to 61. This is exactly where a lot of apes failed. They failed right here during GME because they saw two rip ups to about 160 bucks, thought it was the end, and they sold. How do I know? Because volume. Volume tells you everything that you need to know. If you have a synthetic price failure over 23%, you have paper hands. 100%. I don't know if it's institution or retail, but more than likely it may be a combination of both or one or the other. This is where they failed. I mean, there's these dips here are over 35% or over a 23% dip in price. That's paper hands for sure. Somebody's selling. Again, this is that period of time. Oops, I apologize about that. This is that period of time right here where this is the point where they would have failed at. They would have made a mistake right here. So how do you know if the SPF is real or if it's a sell-off, or that's pretty much how you're going to tell. You're going to be able to tell based off of volume levels and how much it dips in price. Anything over 23% is paper hands. So in this particular image right here, I wanted to just show everybody that there was a specific point here at the end of the day where price drove up really high. I don't have the data on how high that price point is, but do you know how in the after hours we typically see really big spikes in prices? They show up and then they disappear, and we don't see any volume that occurs during that period of time. You need to be really, really careful about some of this data tracking. When you're watching these aftermarket hours, make sure that those are real and that it's actually showing the data, and it's, that you're seeing actual price movement up that high and it's not just erroneous data, right? You want to make sure that these are actual real data points and not just some kind of random glitch. It's really important to make sure you know what's the difference. Now, it will likely get corrected the next day when you come in. Say you stop watching price in the after hours, which I doubt you'll do. But if you do, if you stop watching the price and then you come back the next morning, it'll probably be corrected and you won't see a big spike like this any longer. Um, but I just want to point out here that there are some big price movements. This one may not be so real, but there's some big price movements in the aftermarket hours and the pre-market hours because almost every single one of the pictures that I just showed you there was major amounts of movement in price during those periods of time. This is why on my channel I talk so heavily about having my third rule be the rule where you make sure that you have a broker who allows you to trade in the after hours and the pre-market periods of time. Some of the biggest price movements happen during those. When you look at GME and you go back and you actually study and see what occurred, I think you'll see that it would be to your best benefit to have the ability to be able to make trades during those periods of time. So hopefully, having done this video here, you guys are now educated in knowing what a synthetic price failure looks like. Price moving down 20% is a synthetic price failure. 23% or more means somebody's selling. We don't know who, but somebody's selling their shares. Some of the typical turnaround points or some of the larger turnaround points are 35% and 60%. So hopefully this helped you, and I tried to keep this as short as possible to try and keep it watchable. So I will see you guys on Monday morning. Don't have a good day. Have a great day.